What is going on, everyone? Welcome back to the Solid Finance channel. I'm your boy, Sam Badawi. We're going to do a little bit of a dive into ZETA earnings. They had Q4 of 2025 reporting this quarter, and my goodness, it was a very good quarter. The stock basically started out up slightly, went down as much as 4% after hours, and up as much as 6.5% after hours. Ended up closing the after hours trading around 2.4%. The big question is, where is the company going to be trading at tomorrow at the close? Is there going to be a lot of upgrades on the street? Are there going to be a lot of downgrades? Will tomorrow be a risk on market? Will it be a risk off market? These are things that are more attributed to factors outside of the company's powers, other than killing it quarter over quarter as they have been for the last 18 quarters, beating on both the top line and the bottom line. So let's go ahead and take a look at their earnings over here. I did post it on my channel. Go ahead and follow me at x.com/Sam Badawi to take a look at other things that I post on my Twitter channel, or on my Twitter page, whatever you want to call it. Just scrolling down over here while I am talking, which doesn't really pose anything too good whenever I do that. So ZETA came in for Q4 at $395 million. The estimate was $375 million. That is a massive beat when you think about how well this company is performing on a large scale. Adjusted EBITDA came in at 20 cents, which was right in line with estimates, and they came in for their first quarter of GAAP profitability, just a couple of cents of GAAP profitability, but just enough to push the mark. Additional metrics that came in for an adjusted EBITDA basis: $95 million for this quarter, growing 35% year over year. Adjusted EBITDA margins at 24.1%, which is arguably very good adjusted EBITDA margins for a company like this, growing at about 38% as of next quarter. So free cash flow came in at $55.8 million, and super scaled customers, which is customers paying, I believe, over $1 million on an annual basis, is 184 with 24% year-over-year growth. Now, here are the big numbers that really moved the needle for this company, and I was not surprised to see them beat on this one as well. They originally guided for 38% growth next quarter, as well as about 35% for the entire year. They raised that guidance for next quarter, came in at $36 to $371 million. The prior midpoint was $362. So they raised the first quarter guidance, and they are expected to grow at 39 to 40% year over next quarter, with $61.2 to $61.8 million in adjusted EBITDA. Full year 2026 guidance came in at $1.8 billion, or to be specific, $1.74 billion to $1.76 billion, growing at 34 to 35% year over year next year, with almost $400 million in adjusted EBITDA and free cash flow around $230 million for the entire year. So this is already a free cash flow positive company. This is already an operating profitability company. In fact, they expanded operating margins this quarter again, and they just hit GAAP profitability this quarter. And they did say in the earnings call that they do expect to be GAAP profitable for all of 2026. So very exciting stuff to see. Let's go ahead and look on the fiscal AI for ZETA. Let's take a look at some of the metrics they have over here. For this quarter, they came in at about 25.4% growth year over year, a slight deceleration from last quarter and a slight deceleration from the previous quarters before that. But they do expect to re-ramp revenue up to 39 to 40% next quarter, and I wholly do expect that they are going to beat that. The interesting thing that came in over here is that cost of sales, or COGS, did slightly accelerate, but was kept tamed basically for the last couple of years, which is really good to see, because you do want to see a software company that continues to expand and scale out, but at minimal cost. And something this company really does is, by having gross profit margins around 60%, did contract a little bit. And I think that's what the hesitance is for the street to give them that extra premium up to $24, is because they want to see gross profit margins expand considerably. However, if you do look over here on the operating profit, they came in for EBIT at 4.5% margins, which is really good, as they're inflecting further into margin profitability, and operating profit came in at about $18 million. When you think about a company that is a software company, especially, most of these software companies, they might be free cash flow positive, or some of them are. Some of them are even profitable, right? So you have a software company over here, or a SaaS company, which is what the market doesn't necessarily like right now, that is actually profitable right now. Oh, they're only profitable by 2 cents on a GAAP basis. Yeah, well, they are right now, but they're going to inflect further into GAAP profitability for the next few years, which is really the bull case for this company, right? And they're growing at 35, 40% next year, which is really good to see. So if we scroll a little bit down over here, we got the basic EPS at 3 cents for this quarter, which again is their first quarter of GAAP profitability on a forward consistent basis. They were up about 7 cents just about a year ago, but that was due to a tax benefit or investment benefit, so I wouldn't really pay attention to that one. Basic weighted average diluted shares, they are keeping SBC under control over here by keeping it near stagnant, only growing 1.4% year over year. And if I go here to the cash flow statement and I look specifically at the stock-based compensation only grew 1.7% year over year. So they are keeping the issuance of stock very steady. I just realized I was not sharing my screen over here, so let me go ahead and share my screen real quick. Right. So if I go ahead and look in this chart, I did share this one on Twitter. Let me actually close out the price to forward free cash flow. Shared-based compensation, or SBC, is basically very tame for, actually, let me do last 12 months over here to show you in Fiscal AI. By the way, guys, if you want to check out Fiscal AI, this is my #1 tool whenever it comes to doing research on my companies. In fact, they are giving out a 2-week free trial if you use my promo code below, which is in the show notes. And on top of that, I believe you get a pretty good discount if you sign up for the annual terms. Of course, I do get a cut of that since I am part of an affiliate program, but do as you may. If you do the 2-week trial, you don't even have to give them a credit card, which is actually really cool. So shared-based compensation for the last 12 months, or TTM, was actually decreasing for the last 3 years, while the revenue has been ever so slightly, or not even ever so slightly, has been really increasing around 30% CAGR. So that's always really good to see when you look at a software company. Let's take a look at their valuations over here. If we look at this company from a price to sales perspective on a trailing basis, their price to sales is 4 times, okay? And that has always stayed around 4 times. But if we look at the forward valuation, their price to sales on a forward basis is 2.3 times. You're basically buying a $4 billion company that is growing at about half of that. So in 2 years, they are realizing all of their market cap and revenue. 2.5 years maybe, but I would say, considering this company is growing about 40% next quarter, considering that they are inflecting further into profitability and their operating margins are around 2 to 3%, this is a very cheap company. It doesn't necessarily make too much sense to me that this company is trading so cheap, but obviously the macro is not the best environment when you think of a company like this. So if we think about how IGV has been performing year to date, they're down pretty tremendously year to date. It is not just ZETA that's down year to date. It is your Snowflake, your MongoDB, your Palantir, which is one of the best software companies out there, if not the best software company out there in terms of scale and growth. Microsoft, of course, is the largest software company out there. It's trading under $400, which is the cheapest valuation it's had for the last 3 years. Software is definitely not the place to be in terms of the market if you're looking for a short-term upside. But if you are looking for a long-term upside, you want to stay in the companies that can execute very well, the companies that beat revenue on the top line 18 quarters in a row, the companies that are inflecting or already in profitability, and the companies that are returning value to shareholders by doing buybacks. This company has all of that. And on top of that, they have the AI tailwind of having Athena at the heart of its platform, which they don't even charge for yet. There were more than a few things that were said on the earnings call, and I'm going to share that with you right here. So if I take a look at some of the quotes that I took from the earnings call, let's see here. That was before the earnings started. All right. So David H. Steinberg, who's the founder and CEO of ZETA, said that Athena is close to full rollout. Early adopters are seeing meaningful workflow improvements, and management believes it can push performance beyond an already best-in-class return profile. We plan to make Athena broadly available by the end of the quarter. A select group of customers are already using it, and an early response has been extremely positive, particularly around how it transforms workflow management. And importantly, it's delivering returns that exceed the 600% ROI platform already generates. So for every single dollar that anyone spends in ZETA, they're able to save 6 times that amount, right? So they're seeing a return on investment of 6 times. So whether that's be savings or whether that's be a return in sales, they are forecasting 6 times based on testimonials given by their customers. And they're not even charging for Athena. The going thesis for Athena, according to David A. Steinberg, is that they don't need to charge for Athena right now, because Athena has shown that it improves the cross-selling capability of their product, meaning that when people sign up for Athena for free, they end up paying more for additional services that Athena recommends. So that is definitely something very bullish to see for this company. Let me bring up another thing that was said on the earnings call right here. ZETA CEO David A. Steinberg said OpenAI is a foundational partner behind Athena, with its models integrated directly into the core architecture rather than treated just as another third party in a stack like Snowflake or Amazon AWS. He framed the relationship as long-term strategic relationship, emphasizing that large language models will strengthen enterprise software platforms like ZETA's, not displace them, while both companies work together to drive mutual growth. So the question for this was, what is this partnership exactly with OpenAI? That was something that an analyst asked on the call. So they already have multiple partnerships that basically add on to their stack as far as third-party integrations. But with OpenAI, it's quite different. They didn't go too much into the details as far as what those integrations are with OpenAI and what the partnership entails. But what was said in the earnings call was that they are figuring out ways to improve their partnership, not only for ZETA, but also for OpenAI. My thesis is that ZETA, being that it also offers a generative engine optimization for a lot of its clients, which means that when you use LLMs, you see little hyperlinks that point you to targeted links for that specific user. If someone in OpenAI is using a query and they get results that are specifically catered to them, it's most likely that that came from generative engine optimization. And part of the tools and part of the data that ZETA provides is first-party data, which means that all the data that ZETA collects in terms of generative engine optimization is taken directly from the data that they gather from clients. Now, they don't share all this data, but they extrapolate this data in a way that it targets specific ads to show customers based on their history of using applications and based on their relationships with other people that are searching for the same thing they're using AI. That is a very bullish thing to have for ZETA. Another thing that was said in the earnings call, and probably the last one, is over here. Let me go ahead and share this screen. David A. Steinberg said the company is actively taking market share from TTD or the trade desk, while also acknowledging that share shifts are happening across the broader digital advertising landscape. And at this time was when the company traded up as much as 6% after hours and above $18 per share. TTD reports earnings tomorrow morning, and there's going to be said a lot in that call. TTD is down about 80% from its all-time high, maybe a little bit less than that, but still, you need a 4 times that stock in order to recover its all-time high. They're going to defend their point on there with TTD, but you already have other advertising companies that are basically attacking TTD while it's down about 70% from its all-time high. And they're going to start saying things that show that they are taking market share. But the thing is that it's very obvious ZETA is taking market share because they're growing at 40% next year, which is much faster than the TAM of the entire industry. And on top of that, they're also expanding their targeted TAMs by expanding into different verticals within the advertising and marketing sector. So With that being said, what do I think about ZETA moving forward? I think the stock is going to go to 24 bucks. I think it's going to go to 30 bucks. I think it's going to go to 40 bucks and probably $50. The problem is the macro. That is the only thing that's holding the stock back, in my opinion. You have a company that's trading at a forward 2.5 times price to sales. Its enterprise value, which has a lot of cash in its balance sheet, is also a lot cheaper than that. And on top of that, it's buying back stock, and they're continuing to buy back their stock when they said in the earnings call that they see their price at a very cheap valuation, and they will continue to buy back at these prices as they think there's a lot of upside value on their share price, right? So obviously, they're going to say a lot of things that investors want to hear and shareholders want to hear in the call, but you could very much expect that the high point of the range for the analyst estimates, which I believe is around $23 or $40, will probably go higher, considering that this earnings was a triple beat across the board. I continue to remain bullish ZETA, but I'm not going to go long any options on the stock. Let me take a look at the chart real quick, and then we will close this one out over here. So for ZETA, we have over here that after hours, it's trading about $17.50 right here in the 200-day moving average on a daily basis. It did close and reclaim the 9 EMA and also the 21 EMA if you consider after close. So after close or after hours, it's trading above the 9 EMA, the 21 EMA, as well as the 20-day moving average, which is really good to see. But one thing we also need to remember is that when we have that golden crossover, or that death cross actually, where you have the 50-day, the blue moving average, move under the 200-day moving average, that's when things get a little bit dicey for stocks. But we still are further away from that. And the last time we had the golden crossover, the stock made a massive move to the upside. So are we going to get the 20-day moving average back above the 200-day moving average and therefore back above all the moving averages? That'll be very good to see. But the first thing we need to see is a 9 exponential moving average moving above the 21 exponential moving average. That is the dashed green coming over the dashed blue. And that will happen over the next 2 weeks if the stock continues to trade above $17 per share. So I'm going to keep an eye on that one. If I look on the weekly chart, it looks a little bit better because it's above the 200 weekly moving average, which has provided support ever since it became visible over here back in April. And we're supposed to open tomorrow back above the 50-day weekly moving average, right? If we continue this upside and reclaim these, we're going to become bullish again. But again, this really all depends on the macro. Did we bottom with SAS or did we bottom with IGV? It's IGV coming back. We will continue to see. As far as the volume goes, the volume today wasn't the best thing to see for a 1% update in the Qs or even a 1% update on this SP500. We need some follow through, and it's very likely we're going to see whatever direction this market wants to come in, either after the State of the Union address tonight or after NVIDIA earnings tomorrow. I wish you all best luck. And if you haven't already, go ahead and like and subscribe to this YouTube channel and the video, and leave a comment below if you have any questions, if you want to mention anything, if you want to give a shout out, that'd be really cool. And go ahead and check out my Twitter at x.com/Sam_Badawi. Really hope you appreciate this video. Talk to you guys later.